here just to get this situated and to send this out, because this is the second live of the day. I don't even know how it looks. I don't know if it put it in the proper context. You know, I don't know how it's looking here, so I'll wait until some of you guys get in here. And then some of you guys get in here. It looks okay. It looks okay. That's good to see. It does look okay, so at least I know it's running properly. But like I said, I'll wait until this gets pushed around a little bit, because it's going to take a second. There's no doubt about that. So I'm going to share this myself and force it to share this with everybody. It just takes me a split second. But if it doesn't get pushed around and nobody's here, that's okay. I will just kind of do this step by step and see if it grows as we go. But I do appreciate everybody who continues to tune in. It's a special thing we've got going here. So I'm just going to give it a second to kind of circulate and do what it needs to do. It'll take a second, but it'll do what it needs to do. It does take some time sometimes, especially on YouTube. Once I go on a second time, it's very hard. So I'll just wait for it to kind of pass around. I need you guys,
I'm in the camp that when the Fed
if you guys could hit that like button, it would be very, very helpful right now. Because it's going to be hard to pass this around, because like I said, this is my second time going live, and YouTube is very funky on how it pushes it. So I appreciate everybody finding their way back. I really, really do. I know, but remember what I said earlier, Ryan, when I came on live earlier, I talked about how it's the worst possible day that they could have released this news for XRP, only because I thought rates were going to go unchanged. So let's watch this for a second, because it was unchanged.
A surgical procedure. It's garnering information.
Tea and data dependency.
Now you want a drink again?
Cheers.
There you go.
Newsmakers are moving markets.
Commissioners from the fund.
You simply dismiss the survey data?
In the U.S.
And we'd love to build on that, because earlier on this morning we heard from the Ukrainian AI.
The videos.
You know, holding their neck.
And the strategics, you know.
I mentioned the phone call.
Come on, let's just get to where we're going.
Thinks about this in the fall.
Rate is much lower than where they currently are, so their bias is to
ceiling, but we would expect Chair Powell to talk about that in his news conference. But the change in the...
Here we go.
So for us, the benchmark is the ag. It's around 6 years. You get fours.
what would this cost?
So it goes to Robert Kiyosaki.
Their stock markets when we were above 20. So they're a cheap market, and now they're stimulating. And
bear with me.
By 0.4% on the S&P 500. With the decision, here's Mike McKee.
Well, I was wrong. We do have some news today. No change in rates, but a significant cut in the Fed's view of growth over the next 2 years. A majority of the committee moving lower on the dot plot, even though there's still 2 cuts forecast for next year. There's a pause in QT and a descent on that. The benchmark rate stays the same, 4.25% to 4.5%. But the policy.
Did you guys hear that? Did anybody hear the magic? Did you guys hear that? How many people are here? Oh, it's a shame that it's not pushing this around. It really, really is. I'm going to try some. All right. Can you guys hear me again? I tried to reset it just so it would push it around. Sometimes it freezes. Can you guys hear me? No. He didn't say quantitative tightening. You guys can see me okay. So that might have pushed it around better. But anyhow, we got 56 people now. It's good enough. Is it still choppy? That's why I reset it as well. Is it choppy still? I just want to make sure. It's all good now that I reset it? Guys. No, UK Phil, thank you. No chop, excellent. So guys, they said they need to put a pause to QT. Quantitative tightening. This is huge for risk assets. This is big for risk assets. He said they need to put a stop to quantitative tightening. This is going to be a huge Jerome Powell press conference. I'm going to have to get my charger for outside because I have a feeling at 38%. So let's listen to this. But that's what he said. We have to put a stop or a pause to quantitative tightening. So listen to this. I've already heard most of this.
Makers cut their median GDP forecast for this year to 1.7% from 2.1%, and next year to 1.8% from 2%. Headline PCE inflation rises to 2.7% this year from 2.5%, and core to 2.8% from 2.5%. The unemployment median for this year is now 4.4%, up a tenth. In their statement, officials removed language that risks to the employment and inflation mandates are roughly in balance, now saying the committee is attentive to the risks on both sides of its dual mandate. They emphasize that by saying uncertainty around the economic outlook has increased. That's reflected in the dot plot. 8 members now see 1 cut or 2 cuts or fewer. The median stays at 2 cuts with 2 more for 2026. The Fed, beginning in April, will slow its balance sheet runoff to $5 billion a month from $25 billion for treasuries. It will retain the $35 billion cap on mortgage redemptions. They don't attribute the change to anything, not to the debt ceiling, but we would expect Chair Powell to talk about that in his news conference. But the change in the runoff drew a dissent from Governor Chris Waller, who approved of the no change in policy rates, but dissented on the idea of slowing the balance sheet runoff.
Mike McKee, there's so much to work through here. Appreciate your time, sir. Apparently stagflation is bullish. We'll get to that in a moment. We are firmer in the stock market by 0.6% on the S&P. On the NASDAQ, we're up by 0.8. Mike went through the forecasts and the revisions. Let's do that again, because these are significant changes. Let's focus on 2025 and look at the median projection. The change in real GDP. The projection now, 1.7%, down from 2.1% previously. Those forecasts made back in December. Unemployment up to 4.4%. The previous forecast was 4.3. Core PCE 2.8. The previous projection 2.5, and the median dot unchanged. So Lisa, what we've got here is the Federal Reserve essentially saying inflation is going to be higher than we thought it would be. Growth is going to be weaker than we thought it would be. And as for policy, well, policy doesn't change. What is the stagflationary mix in the forecast that some people were anticipating?
Because we've heard it from all across Wall Street. If they hadn't done this, that would be sort of surprising, since they seem to be reflecting a general sentiment out there. Key question, how are they going to explain why? What has changed? Given the fact that, yes, we've gotten data that has come down, but we haven't necessarily seen a big spike up in inflation, and depending on what inflation expectations you've seen, you haven't necessarily seen them go up that much either. I do think it's interesting about quantitative tightening.
It is very windy.
I do think it's interesting about Fed Waller dissenting, and I'd like to hear a whole lot more. I also think it's interesting you're not seeing a huge reaction from the 10-year yield on that.
He's running. Talked about that a few times. We'll come back to that later. If you don't know what we're talking about, Jim Bianco has thoughts. I'm sure he joins us in just a second. Let's turn to the bond market. Bond yields were higher going into this decision. They are now just about unchanged, around 430. So we haven't broken out that range, that very tight trading range over the past few weeks on a 10-year maturity. The 2-year at 4.03%. There's a lot of conflicting stories, a lot of cross currents to this decision here, Lisa. You've got stagflationary mix in the forecast. The median dot remains the same, implies 2 cuts for 2025. And then you're slowing down the balance sheet runoff at the same time. This is going to be a really tough news conference to navigate for Chairman Powell. With those forecasts, it gets harder.
Especially because he's not giving any explanation as to why.
And guys, I apologize. It's windy, but I can't do this inside because they're working in my house. And this is the only way we're going to be able to watch this. I know it starts in about 13 minutes. I just wanted to kind of see what they were saying in projections. But you guys all heard it here. I think there's 75 people here right now. You heard it. They said they need to stop quantitative tightening, at least put a pause to it. So does that mean Jerome Powell is going to talk about that at 2:30 now about quantitative tightening? That's a good thing. This is a great thing, guys. Don't panic right now. Even though the rate stayed the same, we got a good news disguised in here. A lot of people might not have noticed because they're not into monetary policy like I am. But when they say quantitative tightening, this is the same time I told everybody to buy everything back in, early 23 or early to mid 23. And that seems to be what's happening now. I just got to make sure I talk a little quieter so I don't bother my son. because he's outside and I don't want to make it hard on him.
From Aurora over to
Even before the tariffs that we have currently went into effect, and
Oh, so we're going to look at this stuff.
they're now having to deal with that as well, and that's a very challenging environment. There is a real chill, of course, in terms of what is the carve out for USMCA, and many companies that
No, as I didn't predict, but as I felt, they can't raise rates, or lower rates until end of spring or beginning of summer. So the next time they do this, it'll end up going lower, I believe. I think they're setting the precedent now to, you know, try to lobby now here for lower rates by saying the economy's slowing and things are not as good as they thought and things like that. But now they snuck in that quantitative tightening. So let me do the intro real quick before it gets a little bit later. And I probably won't be doing a live at 6. I'm sure you can understand that this is my second live of the day. So we'll just have to, you know, enjoy what we had together today, and it'll be extended. But I think it's more important for me to be here now than at 6 o'clock. So, and that's why I came on this morning as well. So rates stayed unchanged as we thought. That could put a little bit of a slope here to the downside. But listen, they talked, and even if, guys, the best thing that could happen for us right now is we dive like 20%. And I'm going to tell you why right now. Because this might be the last time we get these cheap prices for a while. And I know XRP is more expensive than the rest. But on some of these, if they do drop 15, 20%, let's just say worst case scenario, he talks, people don't like it, they missed the real news. They just said that they have to pause on quantitative tightening, which means what? They end up doing quantitative easing. And guess what's the most profitable sector to be in when they do quantitative easing? It's risk assets. What's the most risky asset of them all? Crypto. It's all lining up for us for this end of April, not April, but maybe after Easter. It could be the beginning of April, you never know. But this looks like something that's designed for maybe in May, June, you know, around Easter. So I'm very happy about this. I'm so happy about this. It could be May. It very well could be May. In with May, out with a bang. And if you don't sell out after, I don't know, maybe you take a bang. I'm not get bent over and take a bang. But no, there's we often have a rally right before the summertime. I think it's lining up for that again. I really do. But I think the best case scenario here is it would I could see it because that quantitative tightening is exactly why I started buying everything. And I told the Telegram in early 2023. In fact, that's when I stopped the Telegram. A lot of people ended up being against me because I said it's time to buy. I couldn't understand. You know, most of our stuff was 80 or 90% down. I thought that everybody'd be happy, but it was quite the opposite. So we shall see. So good. Let's see. So I want to welcome everybody in real quick. I thank you for spending your afternoon with me. I know that it's a busy time of the day, and I know there's a lot of nerves and things like that, but that's why we try to stay together. It's good to see 102 people in here now. It's at least pushed around enough because whoever wants to be here will be here. So good afternoon. 2:22 p.m. Eastern Standard Time on this Wednesday, March 19th, 2025. I'm XRP Future Millionaire, and I reside in the great state of Michigan. So I got to remember to talk quiet. I gotta talk quiet. Are you sure? Do you want me to go back here then? I can go back there. Hold on, everybody. I'm gonna move so my son can walk out here. I turned my picture off, okay?
I think that's what he wanted.
Yeah, turn the picture off. Tommy, I'll walk over here. Or should I just stand here? Here, I'll move our stuff like this. How about this, Julie? Okay, I moved over just a little bit. My son's out by the front now. Did he open the car? I mean, you could let him sit in there. It'd be easier for you. Oh, yeah, it is hot. George, thank you so much for the $1.99 donation and being in Tom's Army for over 6 months. Thank you, Tom. 2 live stream for the day. Today is enough. Oh, I appreciate that. I really do. I appreciate that. Right now, I've got my this on top of a garbage can. I don't know. figure that's the best we can do here. Since I'm in a weird spot, I'm actually doing this in like the middle of my driveway, just standing here like an idiot in front of a garbage can. People probably think I'm talking to my garbage can right now. That's all right. I sang Sunny Days in the middle of a busy hotel lobby, as you guys remember a couple days ago, so I'm sure I can do this in my own front driveway, even if I am on top of a trash can.
Short duration government bond funds, which told us investors were looking for the safest anchor in the storm. While we're seeing equities drift higher today, maybe it's a little bit of relief, we're seeing the same response. Investors are trying to counterbalance that. Gold has turned up. It's about up $5 an ounce. It was down, and money's gone into the Treasury market. This defines the conundrum in markets. It feels good, right?
Doesn't that feel good? It went into the Treasury market. That means if you're in bonds, mutual funds, things like that, they're going to start pouring into it. We've talked about the safe bet and these volatile situations. Come on, Jerome. He'll speak at, yeah, Jerome Powell speak at 2:30. He comes on and then he basically rounds up everything that you've been hearing here. But yeah, we like to cover this together. So I tried my best to be here. So we're going to watch this. You'll see me coming in and out of this picture because I'm going to walk back and forth to my son until 2:30.
Now, but there's an expectation things are going to get a hell of a lot worse when broader tariffs hit. Yeah. How is the Fed going to deal with it?
John, importantly, not only is gold is up to record highs.
All-time highs, through 3K.
Which has raised this question about what's going on. Is there this larger question about assets moving away from the United States? I just wonder, you say it feels good now. Does this feel good? Does this sort of projection feel good for anybody? I mean, what do you do with this? How come risk assets seems to still be looking for a Fed put at a time where the Fed is telling us we have no clue what to do?
I think everyone's relieved that the Fed didn't jump to significant conclusions, that you're not seeing 0 or 1 rate cut. And I know there's a change in the balance, that they didn't raise inflation expectations to over 3%. I think we'll look further into the statement. I think investors took comfort from that this is going to be a balanced and stable Fed. They know about as much as we do, and who knows what's going to happen over the next couple months.
Is Fed policy still in a good place?
I think it's a miracle. They got us to 4% unemployment, 4% wage growth, 2-ish% GDP, 2.5% inflation from where they were, and now they've been dealt a real problem with a global trade war, which is a stagflationary economy killer.
So I'm going to ask the question slightly differently then, but it's the same one. Is the Federal Reserve in a good place? For any central banker facing downside risk to growth and upside risk to inflation, it's not a good place, is it?
No, I told you, mark your calendar for 2031. That's when the tape of this meeting will be released. It's fascinating. The tension in the room must have been through the roof.
Lisa, regime change. Totally different place for this Federal Reserve to be in compared to where they were before. And I remember earlier this week you talked about the contrast between now and the pandemic. And you made the point that in the pandemic, it was easier for the Federal Reserve because they knew what to do. Just respond with lower rates and buy everything. This time around, it's difficult to know how to respond to these kind of shocks.
And frankly, there still is a lot of disagreement about whether some of these tariffs are disinflationary ultimately down the pike. Right now, they have to not overreact at a time where they are very worried about unemployment rates going up because they know how scarring that can be.
Is anybody surprised that the Fed, is lowering their growth projections? Like, was anybody surprised by this? I don't think anybody is. Well, I mean, most of the mainstream are, but in this community, are we really surprised by this? I think it's going exactly like we thought. Here, let me put this in the background. Oh, welcome to being back outside. You guys know I love doing this outside, even though today I'm forced to. And I don't care. We got to deal with the elements. That's what makes this beautiful.
For an economy and the sort of long lags that can hold.
Syrian, thank you for the $1.99 donation.
Politics. At any time you pick up your cell phone and you look at names 6, 7, 8 newspapers, including Bloomberg News, people are shocked.
Oh yeah, we'll watch Brad Garlinghouse's thing as well.
I think the Fed is part of that discussion. They have to be incredibly ex post until they see those headlines work out, political headlines.
It's one of those meetings, Tom, where you can sort of create a narrative out of everything here, hawkish or dovish. I do think it's material and something we haven't talked about just yet. If you look at the forecast for core PCE, yes, they had to revise that higher for this year, but I think it's notable. You really start to gauge how the Federal Reserve feels about if there is an inflation shock, how long-lasting it will be. Now, I don't expect them to use the T word later on in this news conference, but it's implied in the forecast. They're looking for 2.8% in 2025, relative to the previous projection of 2.5. But then you look at 26 and 27, unchanged at 2.2% and 2.0%. We're trying to tease out what they really think about policy without them telling us what they really think about policy. And I think that's one way of doing it.
So let's translate this. What this means is that there's initial adjustment up in prices with the tariffs, with some of the other trade tensions, with slower growth coming down the trade tension.
Oh, don't you like how I can do 2 screens like that now? Just listen to them in the background, by the way. That's something that I changed. That's a difference. I hope you noticed. Remember, I used to have to have it on the screen. I changed it to where now I can have them on both, so we don't have to look at them. But look at the bond market. Look at the bond market. The 10-year is tanking. It does not like the news right now. But is that a surprise to us? But look, that could be a massive inversion there too. We'll see. They're going to have to inject capital. If you want to know why they're going to stop quantitative tightening, because the bond market's about to implode. Can't do that. That's where they get cheap money. They're the buyers and sellers of last resort. And last resort right now is to stop quantitative tightening, start quantitative easing, and start pumping the shit out of these markets. And that's what I want. Oh, baby, it's going to be sweet. But like I said earlier, you know, don't just barge in right now. You know, let's let this settle for a second if you're not in. And I'm going to start to redistribute some of my holdings. Like IOTX, I think I'm going to redistribute into DGB. Like the speculative. MXC, I think I'm going to redistribute into DGB. You know? So that might be about $4,000, $5,000 that ends up finding its way into DGB if we have any kind of drop here. Which means I might ladder out half the positions, you know, right now or something, and start laddering them into DGB. So that's something I've thought long and hard about, and I think I'd rather have more money there. Can you guys see me? Okay, yeah, you can. Perfect. But for XRP, what are we looking at? It's 230. We're about to go back. But what are we trying to see here with XRP? Right now, we're trying to hold. If it does come all the way back down, you know, that 237 mark. We haven't tested it yet. So would I be surprised if it came down here? Absolutely not. In fact, I would encourage it to. We fill these little areas that could be considered gaps, and then we continue on our merry way. That's why my technical target, as you can see where it was at before the breakout, that's where I think it would go, and that's how it would have to get to 295. So this is absolutely what we want to happen. So let's just stay calm. You know, don't overanalyze, and let's see what the Fed has to say.
With slower growth coming.
Median participant projects GDP.
Oh, here's Jerome Powell.
To expand at a decline in the size of our balance sheet.
Do you think they are watching? Because it doesn't seem to be the survey data. Or is it the
spending and investment? In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit.
That started after he started talking.
Per month over the past 3 months.
I want to hear what he says.
And then earlier in the pandemic recovery. Next 2 years. Continue to expand at a. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year.
Keep talking, Uncle Jerome, baby.
Year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy
Stayed the
actions are guided by our dual
unchanged.
mandate to
It was
promote
unchanged.
maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario.
Come on, just say you're going to cause quantitative tightening. That's all we need to hear.
Exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets.
You don't
Beginning
say.
in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer.
Oh, son of a bitch.
Gains, broader averages lost ground yesterday.
As if it's transitory. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. Tariff inflation moving through fairly quickly and would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that.
Hey, that's a good way to look at the leaf blower.
Actually work out, and the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully. Basically, every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this: you do see increases widely in short-term inflation expectations, and people who fill out surveys and answer, questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think, partly in response to tariffs. And there may be a delay in and further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned
this guy's a
the
fucking
other day,
bozo.
as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Like, give me a fucking break. Look at inflation has started to move up partly due to tariffs. Get the fuck out of here. I'm sorry for my French, but come on, guys. They use any fucking excuse there. They use any fungada they can. They do. They use every single thing they can to bullshit the general public. It's unfreaking imaginable.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth?
When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth from 2.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature, it has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. You've got unemployment, pretty close to its natural level.
I felt it when I was over here.
But job hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs. So you're not seeing people losing their jobs, but you're seeing the people who don't have a job having to wait longer and longer. And the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. It's only been a few months, right? For example, the layoffs that are happening they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area. But at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw it. We've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific things, but it must have something to do with, it's either noise and it will come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers just kind of followed the crowd and raised it. So things happen very indirectly, and so there'll be a lot of work done in the coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last
pandemic? Yes, during the pandemic.
You could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as.
I don't know. The NASDAQ 100 looks like a rising channel is forming. That's never good. So I don't know. We know that they talked about quantitative tightening, probably to begin sometime in April, hopefully. Maybe, I seen Tanya said April 1st. So that means they'll go back to quantitative easing and start easy money. So I expect a massive sell-off probably between now and then at some point. If they're going into quantitative easing again, that means they'll inject the market. They don't want it to be at higher prices. They're going to want it to be lower, a little bit lower. And then, Rick, I mean, if somebody's being very rude, use your best judgment. In this case, I'll let you decide. It'll set a precedent going forward that it's outside of my hands too, because some people are just, gets a little annoying. But that looks like a rising channel is forming.
It's a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on, to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
Makes no
we
sense.
We have two goals, right? We have maximum employment and price stability, and we have to balance those. And there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging, situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is from each of those two measures is from its goal. And then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecasts that really show significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months, a 1 in 4 chance of a recession. So the question is whether whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Gee, I want to start dinner.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and
Basel III, big for precious metals and mining stocks.
The administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I no desire to change that.
Starting to wake up a little bit.
New for you on that today.
Well, well, maybe I have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story. It wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. We look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based, and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of it. we're well aware of how things are going to evolve and the time frames and all that. And, we will use our tools to foster achievement of our goals to the best we can. And of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully. And it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about their implications for the economy. Those things will happen. A lot of them will happen over the course of in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating.
These people make anybody else want to bash their head through the wall.
Inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months? If there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got
ban that person
for goods inflation after a string.
We ban that person, please.
Readings that average close to zero, and you have to ask if it's coming during tariffs. But you can't. It's very hard to
so
actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs, and how much of it didn't. But that's what we'll be doing. We'll be doing that as well as everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what in your mind would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level it's not the change in prices, it's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have 4.1% unemployment. We've got 2% growth, And it's a pretty good economy, but people are unhappy because of the price level. And I do completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think if you, yeah, I mean, remember we came into this with, at the December meeting, the median was 2 cuts, the median was. So you come in and you see, broadly speaking, weaker growth, but higher inflation. And they kind of balance each other out. So you think, and unemployment is really, there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
First of all, if you could clarify, you were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah, so in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, we think, I guess the way I'd say it is, it was the flows in and out of the TG that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee came around to the view that we would do the same thing we'd already done, which once I guess in June, whatever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer, and people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think the reserves are abundant. Although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. Of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It really has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful rundown of the balance sheet. again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations, and they really haven't moved much, if at all. There's one reading that everyone's
this guy's so
on.
I swear he's mind
the other survey readings.
XRP and crypto's reacting fine.
Relatively, well anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change. And in this case, we have tariffs coming in. We don't know how big, what speed. There's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5 year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree there's some weakness in underlying private job growth? And do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but remember we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
I have a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because we want to stop runoff in net at some point. We haven't made any decisions about that. But, we want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in. Constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We see the stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19, basis to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Thank you, Chair Powell. The Fed statement released today removed the line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying a sense of the balance of risks was important, that they be in balance or close to being in balance. It was useful as we approached liftoff. If you remember,
I swear this guy
we're past that.
such a lie.
Beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys.
Oh, and I do want to be transparent. I did buy more DGB. What do I have? 1.6 million now, so about a couple 100,000 more. I decided to start swapping other things into it, like my it's just there's been strategic things I'm doing because I want more exposure to DGB because I'm trying to wither it down, and I really have a strong belief in DGB, and I just feel like I'm given an opportunity here. Yeah, 1.222 million. So, I've got a rather large bet on there. So, I do think DGB, for me, I'm very comfortable there.
That are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from, higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture.
some of the IOTX when it was on a swing up. So kind of a lateral move at the moment.
Before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the twos with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook?
Oh, that'd be so great for crypto.
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter, so I'm gonna pass on that one. Thank you.
He's the fucking Fed chairman. Honestly, guys, it is the most appropriate for him to comment on that question. He's the fucking Fed. If there's anybody who should talk about that, it's him.
Hi, Chair Powell. Daniel Davis.
That'd be like me coming on here and you guys asking me about the news of XRP, and I would say, I'm not really qualified to talk about that. I'm just a chart guy. Let's just ignore the news. It makes no...
From Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the Fomc have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens, it will be complicated, and there will be some retaliation and some not, and all that, but ultimately they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. It slows down the path and probably lengthens it, doubles it effectively by slowing it by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that, but I think what we came up with, though, was broader than that and different than it does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we've said we would do. So that's why, pretty strong support. I just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
He can't wait to get out of there. Chairman Powell, fascinating news conference, the most interesting news conference we've seen with the Fed chair in quite a while. Let's start with the price action. A big portion of uncertainty with a sprinkle of transitory. Equity markets rocketing. We're up by 1.5% on the S&P 500. On the NASDAQ, up by 1.9. On the Russell, up by close to 2. In the bond market, 2-year, 10-year, 30-year yields down and down hard at the front end of the curve by 5 basis points to 398. Check out the commodity market. Gold, all-time highs. Intraday up by about 1/3 of 1%. There's a couple of interpretations here. Here's one. It's the bad news. So they've downgraded the outlook for growth, but haven't responded by projecting additional cuts. Here's the good news, and this is what the market seems to be leaning on just a little bit more. And the Fed chair spoke to it. Based on the forecast, the Fed believes that any upward revision to inflation in 2025 won't last beyond 2025, into 26, into 27. On that and more, take a listen to what the Fed chair had to say.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of...
I think we've heard enough. I think we can all agree we've heard enough. I was going to listen to the breakdown, but I can't do it. I'm sorry. I can't do it. I wanted to listen to the part of the breakdown. I just can't do it. I can't do it. So I'm gonna get going, guys. I'm gonna cook dinner. It's been 1 hour and 15 minutes. This is my second live, and yeah, that is what it is. It always is what it is. I'll do an update soon, but as we can see, XRP, you know, if we want to hold for this inverse head and shoulders on the short time frame, this is the setup right now that it's gonna have to hold. If it comes down farther than I would say about 247, it's likely gonna invalidate that.